Hi there. Gifting your home to your children may seem tax efficient, but it can trigger both IHT and CGT. In this video, we explain the risks.
Hello everyone, and welcome. Today, with some expert guidance from the team at My Tax Accountant, we're diving into a really critical topic. We're going to talk about what seems like a wonderful act of generosity, gifting your home to your kids, and uncover how, if you're not careful, it can spiral into an absolute financial disaster. So let's kick things off with a number. 61 million pounds. What is that? Well, that's how much extra inheritance tax HMRC collected in just 1 year from gifts that went wrong. We're talking about situations where people thought they were making a really smart financial move, but instead, they ended up walking straight into a tax trap. And that's exactly why getting this right is so important. And look, the motivation behind this is completely understandable, right? You want to help your children out, give them some security, and maybe, just maybe, shrink the value of your estate to dodge that hefty 40% inheritance tax bill down the line. It really feels like the right thing to do. But as we're about to see, this simple, well-intentioned gift is actually hiding a minefield of tax rules that can have truly devastating consequences. So to really get our heads around this, we're going to peel it back layer by layer. We'll start with a real-life case to see the hidden costs. Then we'll uncover the first big surprise, a massive capital gains tax bill. From there, we'll dive into an even bigger problem called the gift with reservation trap, see how that can lead to being taxed twice, and we'll even look at the personal risks that have nothing to do with money. And then, most importantly, we'll talk about how to do this the right way. Okay, let's make this real. I want you to meet David and Sarah. They're a couple in their 60s, and like a lot of people their age, they're starting to think seriously about estate planning. They've got a valuable home, and they want to pass it on to their kids as efficiently as possible. So here's the rundown. They bought their house years ago for £100,000. Today, it's worth $500,000. Their goal is crystal clear. Give the house to the kids now, get it out of their estate, and sidestep that future inheritance tax bill. The plan seems simple enough. Just transfer the deeds over to the children, but, keep living there. It's their home after all. Sounds straightforward, right? Well, this is exactly where the trouble starts. And that seemingly simple plan, it starts to unravel immediately. The very first hurdle they smash into is a tax they probably never even considered would apply here, capital gains tax. So what on earth is capital gains tax? Well, it's a tax you pay on the profit when you sell or get rid of an asset. But here's the absolute killer detail, the one that catches everyone out. HMRC treats gifting a property to a family member, like your child, as if you sold it to them for its full market price. So even though not a single penny actually changes hands, in the eyes of the taxman, David and Sarah just sold their house for £500,000. And this creates a really painful situation, something accountants call a dry tax bill. It means you suddenly owe a huge amount of tax, and you have to pay it in cash right now. The problem is, you don't have any cash from a sale to pay it with because you gave the house away. You've got to find that money somewhere else. Okay, let's put some numbers on this because this is where the shock really lands. You start with a market value, £500,000. You subtract the original $100,000 they paid for it, which leaves a capital gain of £400,000. Now, they each get a small annual exemption, but that barely touches the sides. They're still left with a taxable gain of £394,000. At the 24% rate for residential property, that creates an immediate out-of-the-blue tax bill for £94,560. Just wow. An enormous bill they have to pay right now. And, just to add a bit of pressure to all that pain, here's a quick fact for you. This isn't a bill you can just file away and worry about later. Any capital gains tax on a property gift like this has to be reported and paid to HMRC within just 60 days of the transfer. So, not only do they have this massive, unexpected bill, they have almost no time to find the money to pay it. You might think that's the worst of it, but believe it or not, even if David and Sarah could somehow find that $94,000 to pay the CGT, they're about to fall headfirst into a much, much bigger trap. And it's all because they plan to keep living in the house. This brings us to a tricky concept called a gift with reservation of benefit. The official definition from way back in 1986 says it all. It's when you give something away, but you keep some kind of benefit for yourself. In plain English, if you gift your house, but you still live in it, HMRC basically says, hang on, you haven't really given it away, have you? This slide just perfectly shows the dangerous gap between what the family thinks is happening and what's actually happening in the eyes of the law. So on one side, David and Sarah are celebrating. They think the 7-year clock for inheritance tax has started and the house is now safely out of their estate. But HMRC's reality is totally different. Because they're still living there rent-free, the gift is completely ignored for IHT. The house's full value is still counted as part of their estate. And that all-important 7-year clock, it hasn't even started ticking. So how could they have avoided this mess? Well, there are really only 2 ways to make this gift stick with HMRC. The first one, they'd have to move out, pack their bags, hand over the keys, and never live there again. For most people, that's just not going to happen. The second option is they have to pay their own children a full commercial market rate rent to live in the house they once owned for the rest of their lives.
And here's a quick professional tip on that. If you do go down the rental route, this can't just be a casual family deal. It has to be a formal tenancy agreement. The rent has to be at the proper market rate, and it needs to be reviewed regularly to make sure it stays that way. And the kicker? Their children now have rental income, which they have to declare and pay income tax on. You see how the complexity just keeps piling up? So now let's connect all the dots and see how this can build to the absolute worst-case scenario. This is what happens when these tax problems combine with a bit of bad luck. It's the dreaded and financially catastrophic double taxation problem. Which leads us to a very simple but pretty shocking question. Can HMRC actually tax you twice on the very same gift? And the answer, incredibly, is yes, they absolutely can. If you give away an asset, you pay the capital gains tax on it, and then you pass away within 7 years, that gift gets pulled right back into your estate to be assessed for inheritance tax. And there is zero credit, no relief, not even a nod to the tens of thousands of pounds in CGT you've already paid. You get hit for both taxes, in full. This table shows just how brutal this can be. Let's imagine we're talking about a second property. If you use the lifetime gift strategy, you get an immediate CGT bill of over £71,000. Then, if you die a couple of years later, that property gets pulled back in, creating a £70,000 IHT bill. Your total tax burden is over £141,000. Now look at the other column. If you had just done nothing and let it pass through inheritance, there's no CGT, and the IHT is £70,000. The bottom line, by trying to be clever, the family ended up paying over £71,000 more in tax. It's just staggering. And as if all the tax implications weren't terrifying enough, there's a whole other world of risk we need to talk about. This has nothing to do with HMRC and everything to do with real life. The messy, unpredictable parts of it. The moment you sign over those deeds, you give away all your control. That house is now your child's asset, which means it's exposed to everything happening in their life. What if your child goes through a divorce? Your home could be sold off as part of the financial settlement. What if they get into financial trouble and go bankrupt? Creditors could force a sale of the house. And what if, heaven forbid, you have a major falling out? Legally, they could ask you to leave. And remember, these gifts are irreversible. If your own situation changes and you need the money, you can't get it back. Oh, and finally, if you need to go into care, the local authority could see this as a deliberate deprivation of assets and still count the house's value anyway. Right. After hearing all of that, it's easy to feel like it's just an impossible situation. But it's not. The pitfalls are very real, but they are also very avoidable. It all comes down to ditching the so-called simple approach and actually planning this properly with expert professional help. So, what have we learned? Let's just quickly run through the key takeaways. First, gifting your home is not a simple gesture. It's a massively complex area of UK tax law. Second, the simple DIY approach is loaded with traps, like immediate CGT bills and the gift with reservation rule. Third, the double tax problem is very real and can actually leave your family worse off than if you'd done nothing at all. And fourth, the non-tax risks, divorce, bankruptcy, family drama, can literally threaten the roof over your head. But the final and most important point is that all of this is avoidable, but only with proper tailored advice. And I want to leave you with this final thought, because it really sums everything up perfectly. The failure of planning may even leave you in a worse position than if you had done nothing at all. When we're talking about your home, your biggest asset, getting this wrong is just not an option. And now for the important legal bit. Please remember, this is for informational purposes only. It is not financial or legal advice. Tax laws are incredibly complicated and they are always changing, so it is absolutely essential that you get advice that's tailored to your personal situation.
So if anything we've talked about today has struck a chord, the clear next step is to speak with an expert. You can get in touch with the team at My Tax Accountant using the details you see on the screen. They can help you navigate all of these complexities safely. And for more clear, helpful explainers just like this one, make sure you subscribe to the MTA YouTube channel. Thanks for watching.